Introduce the panelists for today. We have Mohamed Manai, who is the manager for OPEV. We have Alejandro Suriano. He's from the Inter-American Development Bank. Marvin Taylor, he's from IEG, World Bank. Then we have Mr. Nathan Subramanian. He's from the Asian Development Bank. And we're supposed to have Tim Turner, but he's been replaced by Doug Barnett, who is from private sector department. We have 3 presentations today. The first one will be from the bank, the African Development Bank, followed by the Asian Development Bank, and then IEG. Then we will take questions from the panelists and then from the audience.
Hey, good morning, everyone. I think this sort of a learning event is just tremendous. I'm sorry that I missed yesterday since I just came back from a mission to Canada. But I guess if you look at the current landscape in development, clearly private sector development is where a lot of countries, and particularly in Africa, and I must say that if during the visits with the head of state in Africa, the first issue or the first idea they came out with always, we like to look at private sector development as the engine for our future growth and poverty reduction and so on. So there's a lot there. And then if you look at the kinds of things that the donor community be able to sort of work in the private sector, generally I think we have a lot to say about regulatory reform, competitiveness, business environment, and so on, and also a lot to say about the enterprise in terms of capacity development. Where the part, from my perspective, that is really intriguing to see how we can take it to the next level is really the growing the business part, where you talk about jobs and so on. So I think this morning, I can't wait to sort of hear the presentations and hopefully and see what kind of observations the different speakers would have on private sector development and what lessons are coming out from their perspective. And after the presentation, I think clearly we would hope that you will be very engaged in joining the conversation, as this is an important conversation to be had. So without further ado, the first presentation is from our dear colleague from the bank. So tell us about what their evaluation of the non-sovereign operations is. Okay, over to you.
I'm going to present the initial findings of the major evaluation that it's not completed yet, but these are really ongoing findings and initial probably lessons that you can get out of this evaluation. We are in our way to to provide the evaluation by the end of the year, and we will go around a discussion about these findings and get reaction from management on these. My presentation will be a small introduction that plus the I don't dwell much on the methodology and approach, but present some of the initial findings and then some lessons and opportunities. This evaluation has covered 4 main areas. One is the strategic alignment of the private sector portfolio of the bank, then an assessment of the portfolio, the risk management system, and institutional efficiency. I am not going to touch all of these dimensions, but the most important ones for the sake of time. What we did is to go through a portfolio data of 137 active projects. Then we have reviewed some of the reports and then undertaken field interviews and visits to 24 projects, which represents actually 18% or so of the portfolio. And then we had some comparable comparison made through benchmarking with other IFIs, and then we looked at the strategy that was developed by the bank, and we had accessed some of the operational documents such as appraisal reports, supervision reports, and expanded supervision reports, etc. And what I'm going to touch is really on the strategic alignment, which is the most crucial issue of the bank, where we need to ensure that the portfolio as it exists now is really aligned to the strategic dimensions that the bank has adopted. The strategic priorities are really so, I can say, varied and somehow complex to understand, where we need to have an additionality to ensure that the bank is additional in financing private sector projects. And to be additional, it has also to maintain its credit rating by ensuring that the risks around private sector financing is well managed, and then have avoid some of the portfolio concentrations, etc., and looking to the whole variety of instruments and touching in some priority sectors like infrastructure or industry and services, and touch some of the small business, micro and SMEs through lines of credit, equity financing, or microfinancing, etc. But most importantly, as the bank is operating in Africa, where some major part of the countries are low-income countries or in fragile state situations, the bank has to cover these regions or these countries, and to ensure that there are tangible development outcomes in terms of improving the financial conditions or the welfare of the targeted population. And the bank also has a major the major challenge is to ensure that there is a financial sustainability of its operations in terms of portfolio quality, operational efficiency, etc. With that, we assess to which extent the PSO portfolio to the strategy's objectives in terms of improving the first strategic objective is to improve the investment climate, and to which extent the portfolio has contributed to and is aligned to this this strategic objective in terms of investment climate. And according to our interviews to the clients, we have found that there is a good perception of how the bank is helping the investment climate, and it was through they said that not too much very helpful, but somewhat helpful in terms of helping the investment climate, and this objective really fits with what we have now as a Bank One concept of integrated operations. And however, there are some issues where our clients feel that probably they need more, and they need more because some of the clients reacted that although the bank has contributed to mitigate the political risk of these operations, there is a strong demand really to improve that climate. And the bank is really requested to think more about how to enhance the bank's interventions in terms of creating the enabling environment for supporting the private enterprises. Here we assess the portfolio concentration in our portfolio, and we said that in supporting the private enterprises, there is the bank has to define clearly what is micro, what is small, enterprises, clearly, and set out in the policy so that we can define, easily where to put the money and who are we targeting. The main interventions to support private enterprises, because 50% of the portfolio around it was through intermediaries and DFIs, and it has probably trade-offs, but we found that there are some concerns, but also positive in interventions that it has helped in having this financial additionality and reduced the risk exposure. And then, but the major concerns here is that the limited ability to monitor and impact development outcomes. And we have found that there are probably different priorities between these institutions, these DFIs or commercial banks, with our own objectives to serve the needed clients, especially the MSMEs. And for that, we see that this concern should be really tackled in getting probably a better way to ensure with the intermediaries that the bank objectives are served and well served, and without losing the control or without losing the access to the end beneficiaries. This is really very, very important finding that we come across the lines of credit and equities, financial, private equities or equity participations. And then, although these fund investments, some of them are increasingly reaching the SMEs, we found that some of them really did not really tackle this issue of reaching the SMEs. But however, once it is done, it creates high additionality, but it has its own concerns that about additional monitoring and management that the bank should take in order to ensure that on these equities we have a good and well-defined exit strategy. We have also a turning point at the point where we have to get exit from this equity, because according to the J curve, if we have really a break-even point, if I may say, to leave as quickly as possible and not wait at the end of the fund to get exit. On strengthening financial systems, here what we have found that the majority of private sector portfolio in lines of credit and terms of loans are well accepted by intermediaries, and they found that it is competitive according to those. But what they would like is that probably more. I talked about this political risk, but what it is needed and more, and I know that the bank did some technical assistance to these intermediaries in strengthening their capacities to reach their clients, to supervise their clients, to ensure that they are taking care of environment, and they are managing risks. We have done this, but there is more to be done with these intermediaries and in making them much more effective. On this financial system and through the intermediaries, we have seen some concern about concentration with unrated bank borrowers. And this probably we need to make sure that the more and more our intermediaries manage their risks and adopt a very effective risk management of their portfolio. On the other hand, what we found is that we have interventions in insurance and leasing sector, but there is a huge opportunity to have more insurance, more guarantees, more and other innovative projects, other innovative products that the bank has. It was revealed by our clients that out of 9 products and instruments that we have, they were aware of only 5 or 6 or so. So I think they are not probably aware of all these products, etc. Now, of course, there is a strong client demand for local currency loans, and it happened that the bank has started in the recent years to provide that. And I think that in the stretching financial system, the bank is doing as good as it were, but it needs also improvement. In building competitive infrastructure, we found that this has really very high catalytic effect. And we have good interventions in low-income countries, and of course they have higher risk ratings than overall portfolio. But we found that the infrastructure projects have limited use of technical assistance. And if you see here, there are some graphs, etc. And I think that what we found is that although we are touching the MICs, so the medium level, we have also operations in low-income countries, but very few in the fragile states, and this needs probably to think through and to serve that objective. So the portfolio is strongly aligned to the core objectives, multiple priorities, and we need probably to have more targeted technical assistance to and use some of the models that were used elsewhere to improve the outcomes. Finally, in promoting regional integration and trade, this we have seen that there is limited number of dedicated trade finance facilities and export. There are some, as we discussed with the private sector department, there are more and more trade finance facilities coming on. But what we need is that there is strong involvement of the bank in order to promote these trade finance programs through local banks, as the other IFIs do, and also support local suppliers where it is. And as a matter of fact, if you see the EBRD, for example, they are providing, their portfolio to trade finance is equal to 7 billion, and there is, high, heavy cross-selling with other bank products. So I, for the sake of time, I will not touch all these. I will probably stop here to see these initial findings and some of the way forward, to be presented, as soon as possible, and to discuss with the management in order to, achieve the one bank concepts in terms of providing the resources and also strengthen our interventions to support and promote private sector and private sector development.
As I put in the title. And then, forcing ourselves to go up one level. The project level is a necessary condition, but we cannot stop there. We need to see it at a wider context, and we need to perhaps, explore thematic, vertical ideas, working public and private partnership in order to address issues. How do you actually, I think your question, the chairman of the prior panel, the question, how do you go from here to there? How do you start to remove, the constraints to access? Well, I think, both public and private sectors have to work together in order to do that. Innovation, another pending task. We talk a lot about, cellular phones and all that. We may have a comparative advantage there. And lastly, corporate social responsibility. And I think, that is an important, and we are seeing in our private sector portfolios, work with large corporates and with large financial institutions that could also be willing to work with us, partner with us, into doing some social developmental activities. And with that, thank you. Merci. Check it out.
Thank you very much, Mr. Soriano. Clearly, given the vast area in private sector development, how do you go about in arriving at some strategic focus on what you want to do and what's your value added as a financial institution is something that we're all struggling with, but then we need to find a way of getting there. Perhaps we can move on to Mr. Taylor. Your perspective.
Yes, sir. As soon as I find.
Well, while you wait to find your presentation.
Yes. Well, I can tell you what the purpose of my presentation is, as I was asked to bring some perspective to these new findings on non-sovereign investment by the African Development Bank, with some knowledge of what we know from IFC's, particularly from IFC's operation, which is the largest world multilateral institution working with the private sector. So that's my purpose, is to bring some perspective from micro work and a few lessons that things that we have also learned from macro work. I don't have to expand on the importance of financing the private sector. Private sector is the one that generates, well, 80% of 80 to 90% of employment is generated by the private sector. 80% of investment is private sector. The role of the public sector is to create a condition for the private sector to generate wealth. So it is critical to support the work of the private sector. Very often, as we saw a moment ago in the previous panel, the development of the private sector is impeded by market imperfections, or by regulations, or by traditions in our countries. And the role of our institutions is precisely to help the public sector to overcome these limitations and also to overcome market imperfections that are faced by the private sector. In the case of the World Bank Group, these operations are done by the three institutions of the group, by the IFC to start with. Most of investment are done through IFC. Investments and guarantees in general are commercial guarantees are done by IFC. MIGA does political risk insurance for those who do not know the context and would like to invest in a country that may be a little bit risky from the political point of view. And then the bank also has an arm, the financial and private sector development, that works basically with the public sector. So there are two clients, right? Private sector clients that are looked after by IFC and MIGA, and public sector clients that are looked after by the bank with the interest of operating in the private sector space. So that's how the organization is set up. There are three types of intervention basically that take place in the World Bank Group. Those who are done through the public sector to influence the private sector, regulations, laws, etc. Things that we saw in the panel prior to this one. Those direct interventions, as I said, the work directly with the private sector and take commercial risk, non-sovereign as you call it here. The institutions are not protected by sovereign risk. And then there are these blend type of interventions that the institutions, particularly the IFC, provide advisory services to private sector companies that are subsidized because they have a public sector component. So these are the three types of interventions that the group handles. There has been a dramatic growth in commitment and in a huge interest in financing the private sector. You can see it there in the case of IFC and MIGA. Huge growth over the last years. In the case of IFC, prior to the crisis, almost reaching almost the same level of commitment of the World Bank, of IBRD particularly, without IDA, growing at a very, very fast rate. And therefore, the need to understand what the implications of these operations are. What is different? Let me focus now on those operations that are done directly with the private sector. What is different about these operations? Number one, that they are subject to market tests as opposed to operations with the public sector. That means that the beneficiaries pay for the services, and sponsors with which our organizations work are motivated by profitability as opposed to private sector. But these operations generate market third-party effects that are not captured by the markets. That's what motivates the interventions of our institution. They generate economic distortion, positive and negative externalities, and again, that's what explains the need for intervention of our institutions and of the public sector. And very important is that our institutions operating in this space must do it based on market principles. That is fundamental. In the case of IFC and MIGA, they operate based on market principles and based on a fundamental principle of additionality. Additionality is important for all multilaterals operating in public or private space, but it's even more important for those operating in the private sector space. Additionality refers to that value that is added beyond what the market would be willing to provide. You exist precisely because the private sector is not willing to provide that service. That's what explains our existence from the market perspective, and the same applies from the public sector perspective. When trying to understand how this works there, we look at the operations from the project level up to the meta level, sectorial, thematic level. And let me share with you what type of things we know now. First, from the micro perspective, from the project level, what do we know about IFC's particularly performance? And in this graph, you can see the performance of IFC in the left-hand side. We know that performance effectiveness is around 70% of our operations on investment, both equity and loans. And we know that in Africa, the bottom line, we know that in Africa, the institutions tend to perform quite below the rest of the world. We know also that there has been a significant dip in the last years, caused especially by the economic crisis, economic and financial crisis. We know that there has also been a decline in the performance of advisory services, the advisory services line of the institution, and that performance, again, tends to be significantly lower in Africa. We know also in MIGA that performance tends to be around 70%. Again, institutions tend to be effective in 70% of cases, which is quite high, but also performance tends to be lower in Africa. Of course, the question is why. There are reasons associated with risk, higher risk in Africa, but there are reasons associated with lower quality of work in Africa, and that we know as well. We know that when we assess the operations, we divide this by different components from private sector development, environmental and social effects, economic sustainability, business success. We know that the lower performance in terms of development outcomes tend to be caused, especially for caused by business success, and which is significantly lower as well in Africa. The institutions tend to perform the worst in Africa from the business point of view and from the environmental point of view. The challenges to work here in Africa, and you know them, the challenge to work here from the environmental and social point of view are much higher than in the rest of the world. We also know, and this is interesting, that there should not be a trade-off between investment outcome and development outcome. Investment outcome for the institution, but because, again, the institution have to operate based on market principles, means that the institution have to be profitable. But the search for profitability of the institution should not come at the cost of development outcome. The majority, in this graph that you see here on the left-hand side, the majority of the operation, you can see them that are in the axis, running from left to right. 77% of the operations are there. High development outcomes or low, high development outcomes or low development outcomes and investment outcomes. There are some operations that are in the extremes. Operations that tend to be low in development outcomes and high in investment outcomes are, you may guess it, there tend to be loans in which the institution is protected, right, by covenants. And so it may be a failure from the development point of view, but the institution was protected from the investment outcome point of view. The opposite is with equity. Those are the operations that tend to generate low investment outcome for the institution, high risk, it lost, it's short, but it generated high development outcome. The same very much applies in Africa. The same patterns very much apply. We also know that work quality is critical. Yes, risks are fundamental. Operating with the private sector is risky. Operating in Africa is risky. But work quality, we have learned that is a fundamental component explaining the performance of the institution. And so we have come to management to show them this fact, right? When they have claimed risk, we have no. There's an explanation here on your work quality. that is behind your performance. And work quality in Africa has traditionally been lower too. So high risk but lower quality of work in the region. You can see that when quality is low on the left-hand side, high development outcome and investment outcome is just 19%. But when quality is high, work quality is high, 69% is high in the institution. And the same thing applies for Africa. You can see it here. High development outcome, investment outcome is 19% when quality is low, and 63% in Africa when quality is high. So these are things that we know about the performance of the institution that may illuminate what you're trying to do here. In general, we know what the results drivers of the institution. In the case of IFC investment, quality of work, as I just said, choice of the sponsor, risk intensity by sector. In the case of MIGA, we also know what drivers are behind the experience of the investor, the business models that are chosen, and in case of advisory services as well. We have a number of, you will have the details of this presentation. In the interest of time, I leave you with that. There are some other things too that we have learned that's from the micro perspective, that we have learned from the macro perspective. As I said, in this pyramid, there are a number of project evaluations that we conduct, and these are some of this knowledge that I've shared with you. From the macro perspective, the thematic point of view, there's some evaluations that, this evaluation we have conducted recently. But I try to summarize some of the interesting lessons that have come up about these more macro evaluations. First is on private sector and poverty reduction. We conducted an assessment of the institution of IFC in its pursuit of this objective of poverty reduction. And the lesson is that the type of growth that the institution may pursue has a fundamental effect on its capacity to have an impact on poverty. Pace and pattern of growth count. It's not enough to say that, you're promoting growth, and so there is this trickle-down effect, and everyone is benefiting. It's not so. Pace, the rate of growth, but also patterns, where you're investing your money, if you're putting into gender, if you're putting in the sectors that affect the poor the most, if you're putting in the regions where the poor are located, not only where poverty is more intense, but where poverty is more dense. So pace and patterns of growth count. Second, the second lesson is that in your pursuit of tackling poverty, you don't have to give up on profitability. It's a good business. Doing this is a good business, which was the subject of our first panel. Financial inclusion. It's a good business. It's just that it's not well understood. So there should not be a trade-off between poverty and profitability. That was the second lesson that was clearly come up out of that study. On technology, we had a couple of really interesting lessons as well in working on technology. It was better, if you're trying again to tackle poverty, it's better to work on general non-targeted interventions. Targeted interventions were a failure. In the case of technology, it's better to work on broad approaches. And we also learned there that since this is a risky, it's very fast-moving business, and there's a lot of risk involved, the assessment, when you're assessing, when you are set up to assess this type of intervention, it's better to assess them on portfolio basis. And this was a huge lesson for us because we were assessing them at an individual basis. And there's a huge rate of failure at individual basis, but at portfolio basis, the performance was quite satisfactory. On crisis response, because let's face it, this is not the only crisis that we're going to be facing. This was one global, but there will be more to come. The lesson there is that you have to be prepared and have your platforms to deliver your service for the private sector ready. In the case of IFC, the strategic approach was fantastic, and they had a great set of new instruments to come up and support the private sector, but they were not ready at the time of the crisis. The good strategic approach, but bad timing. They came up too late with the intervention, and the lesson learned there was that you have to use develop your platform so that they're ready to be used in times of crisis, and this is an important lesson for all the multilaterals. On environmental and sustainability, a lot of work. This is one of the externalities, negative externalities. They can be highly negative in operating with the private sector. The lesson there is that these new performance standards have been working fine. New performance standards that were introduced by IFC and by MIGA since 2006, separating itself from the standards that are used by the bank for private public sector operations. They have been working well, but greater disclosure is needed because they operate more in depositing trust, confidence on the private sector. But you need greater disclosure for them to be effective. And finally, a couple of interesting lessons too that they may resonate with you on private sector and government. One coming out of work on energy efficiency in China, but that is a generic lesson. It showed the importance of the government creating the right conditions for the private sector to operate. That was a very successful program, but it was not due to the program. When we worked on a quasi-impact evaluation, it was clear that the success of the program was due to the regulations that were introduced by the government of China. Huge success in terms of development, low in terms of additionality, and this is the thing that I'm saying, right? Additionality, you were not actually needed. You can generate a huge success from the development point of view, but that's not what explaining your existence is the additionality. It's a huge success from development point of view, but low additionality. In other words, it was not because of the intervention that these effects were generated. And finally, on an issue that comes on and on formality or informality or formalization of firms, we learned from evaluation in Peru, and this is also reflected in the literature, that yes, efforts to formalize firms may have an effect, and you have more firms being formalized. But formalization doesn't mean that firms become more profitable or that they generate more employment or that they grow faster. So, in other words, that there is some rationality in staying informal, and that we have to better understand the reasons of informality and how to work with that. And I will leave you with that as reflection for you.
Thank you very much. There's a lot in there that you talked about, and I must say that I'm quite attracted to your last comment about the understanding of the formality and the informal economy, particularly within the context of jobs. I think the past, when we look at formalizing the informal economy, will be better for private sector growth, and I think there's increasingly more evidence that may not be necessarily the case. Perhaps before I sort of open the floor, is to give my colleagues here, Mr. Subramaniam, as well as Douglas or Mr. Bartlett, a chance to say what resonate on some of the lessons or other observations that you might want to add before we open the floor, and please make it short, a few minutes.
Sure. Thank you for the opportunity. First, before I start talking about specific lessons, I just want to talk about how the Asian Development Bank is organized in terms of private sector lending. Over the last 5 years, the average amount of lending has been approximately about $1.3 billion per year. And a big chunk of the lending happens on the infrastructure side, and about 2/3 of it, and 1/3 of it happens on the capital market side. On the infrastructure side, the focus areas are power, telecom, transport, and water and wastewater. On the capital market side, there is lending that happens to financial intermediaries. It could be either loans or equity. And it also, there are investments to private equity funds. It's a fund of funds portfolio. There's a trade finance program. Selectively, there is investments that happen in structured finance. And then finally, there is microfinance lending. So that's how the lending happens in Asian Development Bank. Now let me walk through some of the key lessons that we have gathered from evaluating at the project level. The first important lesson that I want to bring up is targeting of the investment. This is something that we came across while evaluating a financial intermediary loan that was supposed to be on lend to SMEs. But unfortunately, in a number of the projects that we had done in the past, SMEs were not defined accurately. And SME definition varies from country to country. And if you're focusing an investment in a particular country and the SMEs are not defined, the investment doesn't tend to benefit the SMEs, but rather it gets leaked out to bigger companies, unintended beneficiaries. So that is something that we gave as an important lesson, and we said not only this needs to be defined during the approval of the project, but it needs to be continuously monitored through the life of the project, and it needs to be reported. Another targeting is, as I said, on the capital market side, we provide money to private equity funds. So these private equity funds go on and invest in portfolio companies. But we also provide direct equity investments to banks. So how do we balance these two? Do you do more of the direct equity lending, or do you do more of the private equity fund of funds lending? On the private equity side, you have 2 levels of fees, and you have a finite life. Whereas on the direct equity side, you have more time to see the development impact at the bank level. So this is something that we gave as a feedback and needs to be managed at the portfolio level. The next lesson that we generally gave for mostly the capital market transactions, but also on the infrastructure side, is to incentivize the financial intermediary. Case in point is, for a private equity fund that we were looking at, the private equity fund manager was not incentivized. The people that worked at the fund level were not aligned in terms of the performance of the fund. So they were not getting a big piece of the carry, nor were they investors in the fund themselves. So as a result, the money went to the private equity fund, but the people that worked in this fund were not contributing their 100% for the success of the fund. They were basically getting fixed salaries. And so that's something that we gave as a feedback, said in order for this to be sustainable, in order for this fund to be a standalone fund on an ongoing basis, this needs to change, where the manager themselves need to invest and they need to have skin in the game. Another important point, which, this is a lesson that's already come up earlier in other discussions and also earlier today in the session that happened before this, is the public and private sector coordination. This is key, I think, very key. I'll give you an example on the infrastructure side and on the capital market side. On the infrastructure side, we had an investment in a toll road. And we had the toll regulatory board that was in charge of instituting the increased tariffs for the successful implementation of the project. Unfortunately, the toll regulator was changed with every change in government. And so the toll regulatory board lacked independence, was not able to carry out its mandate, was not staffed properly. And so one of the key lessons that we gave back was to have an independent toll regulatory board so that toll road projects can be sustainable and can be long-run investments. Another thing that happened with the same project was addressing the right-of-way issues. For that toll road project, not most of the right-of-way issues were addressed, but there were sections of the road for which the right-of-way issues were not addressed. And unfortunately, anything you deal with the government, it takes a lot of time to get things approved. And this resulted in inordinate amount of delays in terms of execution of the project and affected the returns on the project. another lesson that is very important is being catalytic and demonstrative. See, when the Asian Development Bank gives money to member countries in Asia, developing member countries, the amount of money that we give is very minuscule in terms of the needs that are there, in terms of the infrastructure needs and the capital market needs. So one of the key goals of private sector investment is to catalyze and be demonstrative in the investments that ADB makes. So that's a requirement that we put in as a lesson in a number of investments that we evaluate. So at the time the project is approved and is closed, we put restrictions on how much ADB can contribute to the project. For private equity funds, we have a cap of 25%. So we ensure that at the closing of the project, 75% of the money comes from elsewhere, from other private players. So the catalytic impact of these projects is very important because the private sector needs to get comfortable with investing in all these projects. And so one of the ideas in terms of picking projects, this has been brought up earlier as well in the earlier session, is we try to do projects that others are unwilling to do or do not want to do because of the risk profile of the project and because of other situations around the project. We want to go into difficult projects and we want to demonstrate to the private sector and to the wider community that these projects can be implemented, it can be successful, you can generate good, reasonable returns, so that once Asian Development Bank moves away, these projects can be replicated and private money can come in, and they can come in purely on a sustainable basis so that they know they can get their money back and a good return out of the investment as well. And finally, one other point is monitoring and reporting. I think this is key. This is very key because case in point, a private equity fund, we did 3 or 4 years ago, we did an evaluation of the entire private equity fund's portfolio. And what came out of that was, there were a number of investments that were made in frontier countries where the private equity business didn't exist, it was not sophisticated. And so one of the reasons that was given for Asian Development Bank was to go in and invest and develop the private equity and the venture capital business in these countries. But unfortunately, since there is no private equity professionals in that country, since there is no experience in terms of private equity funds or venture capital funds, there was a need for the multilateral institution that's investing in this fund to go in and provide some hand-holding help, much more proactive role wherein the bank will go in and help with investment decisions, will help with divestment decisions, and will take on a role that is well beyond what it normally takes on as a passive investor in a private equity fund. So unfortunately, that wasn't done, and one of the key inputs that could have helped in that process is a good monitoring system, where if you had gone in the project and monitored it along the way, you would have found gaps and you would have been able to go in and fix those problems along the life of the project. And so monitoring is very key. And finally, reporting. Once you have monitored, all this data exists. It needs to be synthesized. It needs to be presented in a way where you can establish trends and needs to go up to the senior management so that future lending can happen to areas which need them the most. So with that, let me stop here, and then when future discussion happens, I can chime in again.
Great, thank you so much. Quickly, a couple of minutes from Douglas.
Thank you very much. First, I'd like to say Akwaba, Mbote, Aslama. We're glad all of you were able to come today and participate. In fact, many of you who have come from abroad. Let me start out to say that we've had some very rich presentations this morning, some very good lessons learned, a good overview of our portfolio, none of which that we have a terrible disagreement with. But what resonates, what stands out so much is not what has been said, but some of the things that have not been said. We, especially in Africa, but across all the MDBs, we work in a very complex environment with a lot of moving parts. I'd like to today draw out the analogy of looking at a train set, laid out with the tracks, and we've got everyone looking above to seeing how well our private sector program in Africa is staying on the tracks. And some of the comments that were made by Mr. Manai this morning were based on looking at the OPSM portfolio, but he really was talking about the bank as an institution, perhaps driving the train or being the engine. And I say that because in the context of 5 years ago and still today, we still have a bit of an orientation as a public sector bank. 5 years ago, our private sector lending was under $250, $300 million today, then. And today, it is over close to $1.5 billion. Our portfolio has grown from 30 to 40 operations to almost 200. So you could say that our train has shot out of the station. And at every stop along the way, we've picked up an additional car or two of some new products, perhaps a little bit of trade finance, a little bit of partial guaranteed loans, syndication. These are things that we've only added since the last stop. And if you look at the context of the way the layout of the tracks are, we're coming out of a context where a few years ago, and I don't mean to show our laundry entirely in public, but our country's strategy papers did not include a section for private sector analysis. And this is something that OPSM, as a catalytic transaction department, is working now with our country economists to improve that analysis and to make sure that as a one-bank institution, we can take all of the private sector concerns right at the point of our strategy papers. We didn't look at the context that we've just come out of a very precarious, we're still precarious, but we're in a global financial crisis, so that a large part of our portfolio today is made up of financial instruments in response to that crisis. Otherwise, we too would see that heavier emphasis on infrastructure, something that we're good at, which is part of the hardware for the enabling environment of Africa. We didn't talk about our bank's processes. Mr. Manai didn't have the time to say that. But we find that compared to our sister institutions, they're a bit heavy. And that has constrained the speed of our train and some of the wagons we can take on. And then I would just want to say quickly, since I've been asked to speed up here, the one thing the portfolio review that they didn't look at, and we didn't really touch on by the other commentators, was the relevance of our instruments. Primarily our lines of credit as the instrument for promoting small and medium enterprises. Well, actually, we agree this is a limited instrument. And in fact, OPSM has undertaken a study that looks at how other sister institutions have addressed the ways to best serve SMEs in terms of an inclusive, green, sustainable kind of small, medium enterprise. We look to the Inter-American Development Bank, which has very interesting structures that are funded outside of their normal lending programs, which are really top-level means to enhance that. But that comes at a cost of having a high number of advisors and provision of technical assistance, something that our current budget and structure hasn't allowed us to set up. So it's not so much the things that were said as the things that weren't said, that as we watch the train go around the track, there's a lot to explain our position actually. And just to close, remember we've accelerated from under 200 million a year to 1.5 annually, and we now have a portfolio approaching $12 billion, something that we're very proud of. Thank you.
That's a very good point about how you align the institution. I think Mr. Soriano also sort of touched on that, but did not go dive deep into it given the time constraint. But clearly, how you align the organization and what kind of instruments you would could use to promote private development is still a very much things that we need to explore. So why don't we sort of open the floor for a more interactive, more conversation with the presenters here. Yes, please, this lady.
Thank you very much. Actually, I have a comment and a question to the audience. The comment is about one of the findings of the study related to support of private equity funds to SMEs. Remember that private equity funds have an investment period of 5 years, and most of our portfolio is very young. So it's it's most likely that the results that you are observing are due to the young nature of our portfolio for these institutions. Then my question actually is addressed to the panel. Most of these development institutions are encouraged to document results and their performance. When we look at the key performance indicators used for the originating teams, most of them are linked to the approval level. Do you think that it makes sense to link the performance of these originating teams to the development performance of transactions that they are processing? Thank you.
Excellent question. That gets to the heart of what we are trying to accomplish here. So before, maybe we can collect a couple more, and I will remind, maybe get 3 more, and then I will sort of assign the different tasks and open it up. Rakesh?
Okay. I think I have a micro.
Okay, all right.
I'm Cedric from Africa, coming from Cameroon. It's a comment I want to raise, even from this section and the first section. I think we are missing some information. As you know, before the 1990 or 1995, most of smallholder, particularly in Africa or in French areas, was a bank customers. And then most of them was giving confidence to bank, basically, if I can take the example of Cameroon. But with a loss of transparency and in terms of communication and guarantees, them have been seeing their saving or their money going because of closing of with some of them with no reason. So banks like BIO, as you know, BIO like the International Bank for Africa, Central Africa. And then since that time, most of smallholders are losing confidence to putting again their money in banks. So there's a need for a long-term effort for the bank side, even for the commercial bank of microcredit, to work on standardization and providing a transparency in order to bring incentives to those bank customers. Like we go to North Cameroon, more than some members said 80% of people in Africa, but in North Cameroon, more than 95 people didn't put their money in the bank account. Even small trader or big trader, they prefer to keep their money with them. And then this is a huge issue and an opportunity for banks to tackle. And then there's also need to, not like what the member said, you don't have to take the trade-off between the profitability and poverty reduction. But why not? If you question deeply the issues, we will find some pitfalls on which we can tackle and bring some and see how to motivate those farmers to get back to banks, to bank services. So I want to stop it here. We can continue with the discussion. Thank you.
Small pieces on what they learned from the contest. I think this is very important. And we started the day speaking of inclusive financing, but I think that, and saying, for instance, that banking education, I would like to hear a little bit about the use of language, because African languages are out of all this system. And I think that we should take time to see how what strategies we'll have to develop to include the use of African languages in all this we are doing in order to reach a lot of people. If not, we'll go and turn around and around, but it will be speeches and speeches.
Entities as investors is how do we mine our experience, how do we leverage our investment experience to guide what the rest of our institutions, what the other arms or the other agencies within our respective institutional homes do vis-à-vis the investment climate, vis-à-vis when working with the public sector. This is an area where within the ADB, AFDB, we're finding that we need to enhance our own portfolio management approach to be able to identify and use those lessons. And I was wondering whether the other institutions that are on the panel would have developed specific approaches or institutional mechanisms that enable them to leverage this experience.
We already got 4, so we got to decide in a few minutes. Do you mind? So that because otherwise I won't be able to keep all the questions in my head. With the whether we should measure ourselves in terms of the number of approvals and the amount of approvals versus the hard development outcomes. So what has been the evaluation experience been with respect to looking at this question about development outcomes? Which institution would like to start first?
Okay, let me start.
Okay.
Because it is easy to answer this question because of our portfolio is still young, so it does not harvest the development outcomes. However, we have a system called additionality and development outcome assessment, which needs to be a good predictor of the development outcomes when the operations comes to mature. And we intend to evaluate that in order to ensure that the ADOA system that we have has to be a good predictor for this development outcome. But still, it is an ongoing business for us.
Thank you. It does beg the question about monitoring and reporting. I think the monitoring aspect of it is really going to be quite important. What are other institutions, now that we heard from the African Development Bank, any other institutions, and then I'll get to you, Doug, in a minute. How does IFC approach this with the development outcome?
There's no doubt that we should measure ourselves not based on volume, but based on the results. For years, our institutions have been motivated and moved by the volume that we generate. Well, it's clear now from the shareholders' perspective that this is insufficient. I think it was the Prime Minister that emphasized that point yesterday in his speech. Volume is not enough. And that's precisely why we are here, because we're trying to understand what the development outcomes of these activities are. And precisely this gives me also an opportunity to address the other question. Yes, we are here precisely because we have this will of interacting with each other to try to understand how we measure development outcomes, not volumes, but development outcomes. Volume is important. I have to say that I personally support volume because the economic system is growing. So you're not going to stay at the same size and imagine that you're going to be impactful. You have to grow as well, but you have to grow with a good sense of the impact of your activities. We will continue with this commitment of interacting with the different institutions, particularly with the African Development Bank, in an effort to exchange and share our knowledge, both on the way we do things we interpret development, and on the lessons, specific lessons that I just brought here to your attention, that I'm sure they should resonate to you because they are not coming from space. They're coming from experience here on the ground.
Okay, thank you. Douglas, you were anxious to speak?
Thank you. Certainly a very useful question about incentives and rewarding good performance. In order to have such a system, and if I'm not mistaken, I think IFC actually has that in part. They have incentives for good performing projects that reward the investment officers years later for something they did previously. It seemed to me you need a large enough portfolio in order to adequately measure averages, statistically speaking. You need to have a stable staff where you don't have a lot of turnover or a growing department, so that even if staff transfer from one division or department to another, they're still staying within the private sector world. And third, you need a mature results measurement system, something that has been tested, validated, and is reasonably trusted by staff. And to put those three things in place requires time. And there are not that many institutions out there today that have that. Now, and I think, but fourthly, we can learn from the private sector, particularly those that are in private equity funds that build in those kind of incentives. Of course, there are pressures that come from that to get better results sooner rather than the best long-term results. And finally, there is a place for volume because each year we go back to the board for a budget, and they want to see what our lending volume the previous year was in order to justify further increases. Thank you.
Thanks. We'll move to the next question. Before doing that, I think this whole question of where do you sort of find that balance of using those matrix is kind of important. And I must say that the development outcome side is still in the process, is relatively underdeveloped, particularly with respect to the private sector initiatives. The second question has a lot to do with access, or how do you attract regular people who would deposit the money and using the banking system. What have been the evaluations or the observations been with regard to this specific objective?
That all the shareholders have representation at the board of director level. We require that there are independent board of directors that provide checks and balances. And to the extent there are any deficiencies in the board of directors, we suggest them at approval stage and make that as a condition precedent for some of the lending that happens. So I think that is one key area that needs to be addressed so that you can build confidence in the banking system itself in the eyes of the public. And over the long term, if there are enough of these measures, and if there are measures to address corruption, such as anti-money laundering, measures to address, social safeguard, environmental systems. So it's a well-balanced corporate governance, anti-money laundering, checks and balances that you put in an institution over a long term. I think it should bear fruit, and the public should be able to get more confidence in the banks themselves.
Yeah, because this is a follow-up to the session we had earlier, and I spoke about the three pillars of a good functioning system that, and I said we were just talking about one of them, inclusion, and the complementarity and trade-off of between the three pillars of stability, efficiency, and inclusion. And this is a case in which one of the pillars broke down. So you cannot promote inclusion if you have a circumstance such as the one that you just described. So that's why, again, you cannot talk about one of the pillars only if you don't refer to the other two. Stability, this is an issue of stability and trust in the system that has to be tackled before you can think of expanding the system to users. And perhaps a quick remark. I didn't want to use more time a moment ago just on this issue of incentives. Yes, in IFC there's a different system of a payment system as the World Bank. There's a variable component of a payment system. And the variable component has a short-term and a long-term component. The long-term component includes performance of projects handled by investment officers, and based on that, they receive a respectable package there of amount of money that recognizes how their projects have done from the financial point of view and from the development point of view.
I guess to paraphrase the second part of the gentleman's question on the right is that is there an acceptable sort of a threshold to find that balance between profitability and poverty reduction? I mean, we talked about this morning about the investment outcomes versus the development outcomes. What are some of the evidence been produced through evaluation to get a sense of what are some of the elements that would help you to determine or help us to determine that not so much trade-off, but that balance. The gentleman talked about a trade-off, but I think that the profitability is kind of important so that you don't go out of business. But somehow that balance need to be found at some point.
I think, I mean, in that sense, I mean, we share with our colleague Marvin, I mean, that there is not necessarily a trade-off between the two. However, I mean, what is important to us and what is emerging as ever more important is that perhaps we are having a false sense of comfort with the metrics that we have overlaid on the project at the project level. Because, I mean, we all have actually, by the way, we share the systems, and we have a group in which, I mean, we standardize the metric systems. The way we look at the operations and the success of the operations is true, I mean, at the end. I mean, we also do it at the beginning. I mean, we have a system that accompanies them. But basically, at the end, and the source of the learning of our institutions is, I mean, we look at the project, whether the project did well or not financially. And then, I mean, what the Americans say, the Monday morning quarterback, I mean, basically, once we knew that actually financially went well, it's very likely that we will also tend to believe that we have done a good job in work quality, and that perhaps, I mean, we have had developmental impact. So, I mean, there is sort of an implicit correlation by the fact that, I mean, things that go well, we tend to look at in a good light, that actually prevents us from really being rigorous in regards to what costs what. And then, I mean, there is the issue of, I mean, how do we jump from the project level to the developmental outcome level? And even though we may be measuring things and trying to attribute things to the projects, causality is not there. I mean, let me be very honest. I mean, regardless of how big you are, I mean, you're attributing to your project some developmental impacts to the people who we care about and actually we should be working for, which are the beneficiaries on the ground, the people, not necessarily the intermediaries. It's a very heroic assumption. So, I mean, it's important, at least, I mean, my word of caution here, it's important to recognize what we don't know and not to jump to conclusions that's about, I mean, that we know what works and we know what the lessons are, because honestly, I believe we don't.
In the interest of time, I'm going to sort of group the two questions together and then get a response from the panelists or others. The question raised was, to what extent the country context is going to affect the way you look at, deal with the private sector development, and special references made to the institutional. Is there any, in your respective institutions, any mechanism that you help leverage this knowledge for future programming? Anyone who would like to make a go at it?
I will take the plunge, and I will try and weave in a quick response to a previous question. We cannot be everything to everybody. We've got our selectivity. And in order to make best use of languages in country context, I think we need to work through intermediaries. And that's where our on-lending and advisory services or funding of advisory services to financial institutions, which know the country, which know the local context a whole lot better. That's where we can leverage the rich knowledge found in different languages. In that same way, to address languages and to increase banking, banking is about, is increasing access and having trust. And the one thing that comes to mind in Africa, where there are not a lot of bank buildings in rural areas, is mobile banking. And that requires mobile cell banking, like Kenya is the leader on the continent. That requires national regulation and development of products through cell phone companies. I'll stop with that.
Well, thank you. The organizers just reminded me that lunch is supposed to be 12:30. How much time do we have, or do we have time for the second round, or you 5 minutes? Yeah, we can have 5 minutes. 5 more minutes? So, because I don't want to deprive these gentlemen waiting anxiously to ask the question.
Thank you, Mr. Chairman, and a member of the panel for your insightful and forward-looking presentation. My question goes to Mr. Maina, who has just presented to us the evaluation finding of private sector operations. We have learned that you have shared with us some of your key findings regarding to the financial issues, portfolio management, and credit risk management. I was just wondering and a bit surprised. Can you tell us more about what is one of the development outcomes respect to environmental and the social issues, and where are we in the bank? I have just completed 20 mega projects under quality assurance and result department, which I was task managing. And one of the findings suggests that one of the serious issues that contribute to the project delay during disbursement is the financial and the environmental issue. So could you just say a little bit about that? Thank you.
I think this is the major part that the bank has done, good, has taken good steps in ensuring that the social and environmental impacts are taken into account, from the, inception stage up to the maturity of our projects. And the bank has helped a lot of these projects, or intermediaries to have their own environmental and social impact assessments and give them the necessary technical assistance for that. But the demand is so huge because we need to ensure that this is functioning, that the end users, the sub-projects, the SMEs and others are also environmentally, friendly, and also that they are, and as I think we have mentioned this morning about the corporate social responsibility, that the social responsibility of our private sector has to be enhanced, and we are pushing hard with intermediaries, the development finance institutions, and regional banks, sub-regional banks, to have this dimension into account. And the bank has not to lose control of this aspect, because this is really what the bank is keen to promote, in its strategies and policies. So all the safeguards, we need to look around in terms of evaluation. We are now undertaking the environmental sustainability of our transport sector projects. And we are also, we will have a discussion, I think this afternoon, about mainstreaming environment and other social issues. So it's not really so easy to be, affirmative, to say that we are doing a good job. We are taking steps, but there is also need for improvement for areas where we have to make sure that this, for example, if you take private equity funds, we need to make sure that these also are taken into account in these, and probably try to educate the fund managers to be keen on that, and be probably within the investment committee or the advisory committee to make sure that these are really well taken into account. So this is really a long answer for your short question. Thank you.
Actually, this is a very, very important aspect in the sense that it goes back to the very first question that was raised. We have to really, in many ways, think about how you make the development outcomes in the environmental and social sustainability aspect of it to be explicit. And I must say that I sort of look at the Canadian government have 100 million on the equity fund in the managed out of London, out of Actors, and we put in place a component of saying that, well, you know, your fund manager have to be really report on the environment and social implications, but it's very tough because we didn't do it right in the first place to really be clear about what the expected development outcomes coming out of that. So it's a huge area for work. I think clearly we're in the right direction. I guess on this note, let me just sort of thank you on your behalf. I'm sorry that we running out of time, and perhaps we can sort of, you can catch the panelists after this. But let me just thank all of you for sharing us with your knowledge and your thoughts about this important area, and I'm sure, and we must make sure that this is not going to be the last time. It's the first but not the last time. Great. Thank you so much to everybody.